there, Dale.
Hey, happy Tuesday.
It definitely is. It's seeming to be happier and happier every single week because, well, take a look at the rates. Where are we at right now, Dale?
Well, we're sitting at about 6.63 a week ago, right? And when we did this the week before, we were about 6.72, if I remember correctly. So we've got about a tenth of a drop, which is nothing great and fantastic, but it's certainly better than the other way. And
Yeah, that's true.
Things are hopefully looking good.
Yeah, and as these are week averages, we do actually expect this number to decrease this coming Thursday a little bit more.
Yep.
And it's going to be a total of about 0.25% that we saw from about a week ago when you tally everything up, which is an interesting number. We'll get into why it's so interesting at the very end. But you can see we had a very good jump in mortgage-backed securities. Green up is good, red and down is bad. This is an inverse to mortgage rates, and we have plateaued right on this floor of support at 101.76. Hopefully we can stay above it. We don't go below. And if that's the case, we're probably just going to see this as our new rate environment unless there's a big shakeup in the market. And, well, inflation is one of those things that we look at, and it's sticking pretty strong. It's not moving. July CPI inflation numbers only rose 0.2% for the month, and year-over-year inflation, yeah, it did rise technically, but from 267 to 273, it is somewhat marginal. Dale, this is with 4 months of tariffs accounted for, April, May, June, July. So we don't know what's going to happen in the future. Everything is always subject to change, but now we have 4 months showing that tariffs are not necessarily in charge of inflation as much as we thought. So, Dale, big question, what's going on with the market? When are we seeing a cut?
Well, that's a great question. And, right now we're pricing things at a 89.4% probability of a quarter basis point cut by the Feds in the September meeting. Now, you got to shift back and look at a couple things. When we lock in a loan, almost all the time, it's a 30-day lock. Meaning lenders are looking ahead for a 30-day investment period, if you will.
Okay.
So today's August 12th. They're meeting in the Feds 30 days from now. Lenders have already priced this in to their pricing.
Right. Okay, so the simple explanation is if I have a little birdie on my shoulder saying, hey, there's a 90% chance they're going to cut the rates, and I'm thinking, how can I get ahead of my competitors? I'm going to cut my rates early because my loan's not going to close for 30 days. Did I get that right?
Right on the money. That was a very perfect and easy explanation.
All right. So Realtors, what this basically means is when everybody sees the Federal Reserve announcing a 25 basis point rate cut in September, they're all going to shout hallelujah and go shopping, but that's in September. And if it's already priced in the market right now, which as we saw at the beginning, we saw that the interest rates dropped about 0.25%, it's time to get into the market. It's a buyer's market right now. A lot of listings are sitting, not a lot of buyers, and you can make creative offers to get a little bit better a deal for your clients. So get ahead now, call your database, and get them shopping today. All right.
That is very sound advice.
All right. Well, tell my wife that I'm capable of good advice, and I'll catch you on next week's episode.
Yes, I'm wrong all the time too. So there you go.
All right. Let's go away before we're in trouble. See ya.
Have a good day.
Bye.